Hey there, I'm estate planning attorney Paul Rabelais, and in this video, I'm going to describe how someone with a $5 million estate can save at least $2 million in estate tax while protecting assets from lawsuits against you, protecting assets and your children's inheritance from lawsuits against them in the future, and how to protect your children's inheritance from their potential future divorces. Now, I realize that not everyone watching this video has an estate that exceeds $5 million in value. But the conventional wisdom in the retirement planning space is that you should start in your 20s and put the cumulative effect of a compounding rate of return into effect so that when you are in your 50s and 60s, you have more than enough assets to cover your expenses for the remainder of your lifetime. For example, if a 20-year-old can be disciplined enough to save $2,000 monthly for 40 years and earn an 8% rate of return, they will have approximately $7 million when they turn 60 years old. So this video is for people who, whether through savings, inheritance, building a business, or otherwise, have accumulated a few $1 million worth of assets, many of whom worked very hard to do so, and now want to know simply how to keep it and pass it along to the next generation intact while avoiding intrusion by the IRS, plaintiff lawyers, and future ex-sons-in-law and future ex-daughters-in-law. So it all starts with how to avoid millions of dollars of estate tax and keep it in the family. Here's the deal. Until the year 2026, estates will have an estate tax exemption that exceeds $12 million. What this means is that if you pass away prior to 2026 and you have a net estate that is worth less than $12 million, then the 40% federal estate tax will not apply, and you can pass your estate along to the next generation free of the 40% federal estate tax. At this point, you may be thinking, no problem, I don't have a $12 million estate, so I'm good. And if you're married, you might be thinking, each of me and my spouse has a $12 million exemption, and we are way under $24 million, so why are we even talking about this? But stay with me. In 2026, even with no action from Congress, the estate tax exemption will be slashed in half. My estimation is that starting on January 1st, 2026, the estate tax exemption will be about $6.5 million. And let's say that you currently have an estate of $5 million or more. In fact, let's use $5 million exactly. The potential problem is that your estate is going to keep growing, and when you pass away, the 40% federal estate tax will apply, and you will roll over in your grave when your family, within 9 months after your death, has to sell your estate assets to pay millions of dollars in estate tax to the IRS. You see, if that $5 million estate appreciates at a 6% rate of return over the next 20 years, that estate will be worth more than $16 million in 20 years. Now, we don't know what the estate tax exemption will be in 20 or more years, but it's likely your estate will be subject to estate tax. So a solution to saving millions of dollars in estate tax is to take advantage over the long haul of the present interest annual exclusion. The idea is to take a little slice of the estate every year and set it aside, perhaps in trust for your heirs, so that at the end of the day, when you die in 20 years or so, a big chunk of your estate is outside of your estate, outside of the reach of the federal estate tax. Let me give an example. Let's say Richard has a $5 million estate. He has income that he lives off of, and he doesn't plan to spend all of that $5 million. Richard and his wife, Josie, have 3 children. Richard thinks to himself, I have a $5 million estate. I have most of it invested, and it's likely to grow. I don't like paying taxes. I've been paying hundreds of thousands of dollars of income tax every year. I'm sick of paying taxes, Richard says. And the estate tax, Richard says, is a form of double or triple taxation, taxing assets that have already been taxed. Richard says, I'm not a big spender, and I think a 40% estate tax should be illegal. I'm going to do what I can to avoid it. And Richard says, as I think about it, if my estate grows at 6% annually, my family could face a huge estate tax when I pass away. So I understand that my wife, Josie, and I can each donate $16,000 annually to each of our 3 children. That's $96,000 of gifting we can do. Heck, my $5 million estate is going to grow, 6% rate of return, is going to grow by $300,000 this year. So I'll just take a sliver of that and put it in crummy trusts for my kids. See my video on crummy trusts. Richard does some math and realizes that the $16,000 present interest annual exclusion, which gets adjusted each year for inflation, will increase by about $1,000 every 4 years. So if Richard and Josie max out just simply their present interest annual exclusion giving for the next 20 years, and those gifts are invested at an 8% rate of return, then in 20 years, they will have a pool of funds totaling more than $5 million, saving more than $2 million in estate tax. In addition to saving millions in estate tax, if Richard sets up these trusts a certain way, the trust assets will be exempt from any lawsuits against Richard or Josie, and these trusts will be exempt from lawsuits against their 3 children, and the pool of funds will be protected for the children in the event the children get divorced in the future. So here's another way to look at what we are addressing in this video. It's no-brainer common sense to start in your 20s to build up an estate using compounding rates of return, which allow your wealth to grow faster so that you will have a multi-million-dollar estate in your 50s and 60s to retire from. There is a humongous financial services industry that helps people do that. My point is, realize the estate tax is likely to come back in a big way starting in 2026, and maybe in a bigger way than anticipated, and maybe earlier than anticipated, depending upon what Congress does. And an easy way to beat the 40% estate tax is to take advantage of the time that you have on your side from your 50s and 60s until your 70s, 80s, and beyond to gradually shift assets from your estate, where they will be subject to a 40% estate tax when you die, to an area where they will be subject to 0 tax when you die. So going back to the example of Richard and Josie, who start at 60 years old, or who at 60 years old started transferring a sliver of their estate into crummy trusts to take advantage of the present interest annual exclusion. And 20 years later, Richard and Josie had a $5 million pool of assets that will not be subject to the 40% estate tax when either Richard or Josie die. Those assets will be protected from potential judgments against Richard and Josie. Those assets will be protected from potential lawsuits against their children. And those assets will be shielded from the potential divorces of their 3 children. In addition to that estate tax-free $5 million pool of family assets that passes free of the 40% estate tax, Richard and Josie still can each utilize their full estate tax exemption to shield assets that remain in their estate, whatever that exemption might be at the time that Richard and Josie pass away. So the key here is to recognize the potential problem early. Know that people should be in the retirement planning mode from their 20s until their 50s and 60s, but once they are secure that their assets are more than sufficient to cover retirement income needs, they should put time on their side to start the estate tax avoidance planning from their 50s and 60s until their 70s, 80s, and 90s. If you wait too long to start the estate tax avoidance planning, you will not be able to get it out of your estate fast enough and take advantage of compounding rates of return to build assets outside of the estate, thus failing in your attempt to keep your estate in the family and away from government intrusion. I'd love to see your comments to this video. I'd love to have you like and subscribe, and we'll see you next time.